Hello,
Right.
hello, everybody. Brian Hoops here with Midwest Market Solutions, and this is our monthly webinar. And today I am joined by Jody Miller from our Thief River Falls, Minnesota office. Jody, I've loved to have you on here. Wanted to have you on for several months now, and just seems like our schedules would not make it work. So I'm happy to have you with us today. How are you doing?
I am good. Thanks, Brian. How are you?
Hey, I am doing well. As I said, I've been wanting to have you on for quite some time. Tell us a little bit about your background, where your office is located, maybe some phone numbers clients can get a hold of you, that sort of thing.
Okay. Well, the office is located in Thief River Falls, Minnesota, which, yes, it's about an hour from the Canadian border, so we are up here a little ways. What we do in our office is obviously concentrate on commodity marketing, helping farmers to make their sales at the elevator, and then also different strategies that we can do as far as puts, options, and futures strategies. Our main focus truly is helping the farmer get their grain sold and helping them generate the cash that they need in the time manner that they need for their farm, and then doing different ownership or different marketing strategies from there. We also are a crop insurance agency, so the way that your crop insurance plans are developed these days, they directly influence your marketing decisions. So it is very beneficial for a farmer to have marketing advice with also somebody who has the background knowledge of the crop insurance world. So that is kind of our broad overall, I guess, synopsis of what we do in our Thief River Falls office.
Okay, and do you have a website, Twitter? I know you're on Twitter. Website, phone numbers, Twitter handle, anything for clients can reach you?
Yeah, the website is www.northernaginc.com, and I'm not very active on Twitter. I think I look at it more than I actually repost, so I will not throw that Twitter handle out there at this time. But we do have a Facebook page, Northern Ag Incorporated, and we do a lot of direct text messaging to our clients and to those who subscribe. So if you're interested in getting any sort of updates from Northern Ag Incorporated, you can shoot me an email. It's jody@northernaginc.com, or give our Thief River Falls office a phone call at 218-681-1431.
All right. Like I said, I've been wanting to have you on for quite some time, and I thought it would be good this time of year to just have you on, and you and I can talk about some different marketing strategies. We're getting into this harvest time frame, and I know producers kind of been knocked out across the Midwest. You said there's chances of snow up where you're at tonight. There's a lot of rain moving all over the Midwest, and in the next week, in fact, we're going to be knocked out of the fields in a lot of areas. So the producers may have a chance to look at some marketing strategies for corn, soybeans, and for wheat. And I want to just take a few minutes here to go through this little webinar and talk about some strategies that producers can use. Of course, we're just going to give you a couple different strategies for corn and soybeans and for wheat, but to get more in-depth, more of a personalized marketing strategy program, you can definitely go to Jody's website, contact myself or any of our offices, and they'd be glad to assist you set up a more personalized service. I know Jody offers a more personalized marketing service. We offer one as well for cash sales and for hedging strategies. But Jody, I'm going to let you talk about the first strategy for corn that you came up with in here. It's using the CCC loan program, and give us a little bit of a background of it and some of the benefits and disadvantages to using that program.
Well, I don't typically like to use the loan program if I don't have to, just because it's another thing that a farmer has to do to go into the FSA office to take loan on their grain. And, you know, usually we like to have prices decent enough where we can just use the market as it sits. But in this particular year, I feel like that this taking a loan on your grain might actually be beneficial. The biggest reason why I want to do this is because basis levels should show a pretty decent improvement, at least in wheat and possibly in corn in the next 2 to 3 months. So what this would do is it would allow you to get some cash coming in so you could pay some of the bills that we all know are pretty frequent at this time of the year. And so it free up some of that, give you some cash flow for that. And then also it would allow you to retain the ownership so that we would be able to wait for a basis improvement. If you are able to see a decent basis improvement, you're able to go ahead and sell that grain obviously at any time, and just work with your elevator manager and the FSA office to get that repaid the way that it needs to be. The downside risk, of course, is if prices continue to fall. So if you wanted to, if you were happy with your futures level at this point and wanted to protect that, you could always buy a put options to protect that part of it. You know, obviously we have no way of protecting the basis, but we are feeling that we should see an improvement in basis levels, hence the reason for generating some cash with the loan route. And then you could be buying a put option to protect yourself from prices, the futures prices going lower.
All right, exactly right. And the two strategies that we're going to talk about, you could actually use these together. The one that I had came up with is to sell a carry in the market at our Midwest Markets marketing program, our Market Solutions program. We have about 40% sold for harvest delivery to generate cash flow for clients, and the 60% we are putting in storage. And we want to capture the carry that's offered out there by selling July futures against this. So you're going to sell July at 405, and hopefully you get some basis improvement that Jody's talking about. And the advantage to doing this is you're getting 25-cent better price than what is offered currently for the December market. And once you've sold the crop, you have absolutely no downside price risk. Now, here's a couple of other points that we can talk about here. Buying a July call retains ownership, and I typically would like to spend about 2 to 3 cents per month to re-own that crop, and that's usually less than elevator storage. A lot of elevators are 4 or 5 cents a month if you paid storage to retain ownership of the crop in their elevator. But you can do that with July options and get yourself a pretty close to at-the-money option and give yourself upside potential. The other thing you can do is you can use both these strategies at the same time. You could go ahead and put the crop under loan and generate some cash flow that Jody's been talking about at $1.95, sell the carry for $4.05, and then you would have no risk of prices moving lower whatsoever. You get the cash flow, the money coming to you, and then you just have to repay the loan down the road when you make the sale of the crop. And so you can also benefit with this with basis improvement. So it's kind of a combination of these marketing strategies. If you need to generate that cash flow, go ahead and do the loan, but then go ahead and make sales at 405 as well. As we look,
one more thing before you leave the corn page, Brian. One thing that some elevators in our area are offering for farmers, I'm not sure if it's widespread throughout the United States, but you can either do this through an elevator or you can do it on your own as well if you just sell the grain at the elevator and then use your hedge account to finish out the rest of this strategy. But one thing they're doing is you would be selling your cash corn now at today's futures price, which would be $3.68. And then what they're doing, and then taking the basis, obviously, that's being offered at the elevator, and then they're selling a call option against it. They're using the December 19 contract. And if you're doing this at the elevator, basically what they're saying is, if you use this for 5,000 bushels, then if you're at or above the strike price on around November 23rd next year, then you owe them some bushels for the 2019 crop year. So it's kind of nice that you can do some of that type of strategy also. If you do that in your own hedge account, then you of course will be subject to margin calls. So if you're not comfortable with margin calls, this would not be the strategy for you. But the December calls, like say even if you go with like a 420 call option, that's going to add about 20 cents to that you would be receiving. So if you do it through an elevator, you would be getting, close to $3 cash for your cash corn and then add another 20 cents onto it. That does help. But then, of course, you have to realize that you may owe them more bushels come harvest time in 2019. So that's another strategy that's being thrown around up in our area anyways.
Oh, that's a great point. I'm glad you brought that up. And, there's so many variations of these strategies that we could throw out there. We don't want to confuse anyone, just going to give you a couple different marketing ideas. But if you want more in-depth or tailor something more to meet your particular cash flow, contact Jody or myself. Maybe you don't want to store it to July, you want to go to March. We can help you out with getting some prices established for that time frame. Let's go to soybeans, and it's not that much different of a strategy as what we talked about in the corn, but walk us through any differences and what your strategy here is for the soybean market, Jody.
Well, the reason why I suggested taking a loan on soybeans is because obviously the basis levels are horrendously horrible throughout the entire Midwest. And so not that I am extremely hopeful that we're going to get that much better on basis levels unless some sort of a deal gets struck with China, but I at the same time don't feel like they're going to get much worse. So I think that we could hedge our bets on maybe even seeing a slight improvement in soybeans. Nothing huge, but maybe, 20 cents helps tremendously when you've got margins as tight as this. So I would suggest if you need to generate some cash flow, taking a loan and then waiting for some better prices to come along. Obviously, the downside risk is if prices continue to fall and don't go higher, then you would not have anything locked in on the future side of things. And then, of course, the basis is left open as well. So you do have some risk. The best thing about taking a loan is that you're going to be able to free up some cash and get some bills paid in the time.
And talk about the downside risk if prices fall. People may not have had used this strategy for many years. You're basically taking a loan at $5, and that's what you're receiving is a loan proceeds. But when you talk about price objective or prices fall downside risk, how much downside risk is there?
Oh boy, I guess everybody's got their own opinion there. How much more downside risk is there? If you look at monthly charts and very long-term charts, I suppose the futures could drop to 775, maybe even lower. I guess if things really continue, if the crop continues to get bigger on the USDA monthly reports and that kind of thing, maybe there is some more downside risk potential out there. So again, same kind of strategy in the corn. If you wanted to protect your downside, you could buy a put if you're going to go along with this loan. Use some of the money that you're going to collect for that $5 a bushel loan, and then go ahead and use some of that for buying a put to protect yourself a little bit on that.
Absolutely. And when you take the loan out at $5, prices could go any direction, up, down. If they would fall to $5, you've got $3 of downside risk. That is also a potential if, in fact, things get real bearish. And let's talk about a different strategy, but we can also use it in combination. I like selling July soybeans here, selling the carry, and this is very similar strategy to the corn, where we have recommended to have 40% sold at harvest for our clients, and that generates some cash flow. So then the rest of the crop you would be looking at storing into July timeframe. July beans are a little bit less than this, but we wouldn't be looking for much of a rally to get to that 925 level. And once we make that sale, then there is no downside risk. We don't have to worry about prices moving lower. If we want to look at options, call options to re-own this in case there is some sort of agreement worked out with China and prices rally and recover, we can use these call options to retain ownership. So, no downside price risk here. If stocks do build, as what some people are talking about, there's some talk we could have 1.2 billion bushels of soybean carryout as yields increase, old crop stocks get bigger, and demand slows as there's no resolution with China. So I think this is a good strategy from that standpoint. You don't have any downside risk. You can keep your upside potential wide open. And if you need to generate the cash, you can do the CCC loan program once again and go ahead and generate some cash flow through that process. Any other comments on this, Jody?
I do like what you just said, Brian. I'm not entirely overly optimistic on the soybean market just because of the sheer volume of soybeans that we have to harvest for this crop year. Even without China, I mean, our exports, the projections are very similar to where they were last year. It's just that we're having more non-traditional purchasers come to the United States. So, will China help a lot if they make if we can make some sort of a deal, yes, I think they will help. That would help. But I don't think it's the cure-all because of the crop size. So being that, I don't know that I want to actually own the physical commodity for very long. So with this loan, what it's doing is it's helping you to generate some cash, letting us see if we can get some sort of a small improvement in the basis levels. But I like how you want to sell out in the July contract. With a target up there and then re-own with the call. I think everybody, the farmer is the eternal optimist. And so I think that everybody kind of wants to have that hope. So I think buying a call option is going to be the best way to be able to have that hope and realize gains if something beneficial happens, but it's going to be the less risky way if something does not happen, in meaning a communication with China. So I do like the strategy that you just mentioned, and I think we'll be using that quite a bit for the farmers up here.
Yeah, I like it too. And again, if you don't want to store it out to July, maybe you want to go March or May, even after the first of the year, there's some strategies here that we can employ to take advantage of that. Just contact either Jody or myself. All right, let's look at spring wheat here before we finish up with our webinar. And we did spring wheat and want to talk about that. Do you want to go ahead and talk about the loan program with spring wheat, Jody?
Sure. Basically, it's the same thing we just talked about with corn and beans. So you'd go in and take your loan on the wheat. The reason why I want to take a loan on wheat is because I feel very strongly that we're going to have a decent improvement in basis levels in a couple months. It's not going to come, it may or may not come in November at the typical time frame when we usually have it, but I'm thinking at least by December or even January, I'm expecting to see anywhere between a 30 to 40 cent improvement in the wheat basis levels, at least up in our neck of the woods, growing spring wheat. And so I definitely don't want to be selling it at the elevator right now, just because of the simple fact there's no way to regain anything on the basis levels once that's sold. So if you need to generate cash, again, just take the loan and then we'll wait and see, should see a basis improvement, like I said, in the next 2 to 3 months. Again, not looking for anything astronomical to come in the wheat market, but I think with the world situation, the way that it's sitting with some of the major producing countries having production problems and some areas having some concerns for their upcoming crop, I think it's going to be an exciting market to watch. Might not be right now, but maybe in a month or two it could start to come alive. Russia is the big player there, so we'll be watching for comments that come out of Russia as far as them shutting down any kind of export programs that they have. So that will help to alleviate our basis. Our spring wheat crop up here was a decent sized crop, very big, much bigger than it was last year. Last year the drought really hurt quite a bit. Drier conditions this year, but not as bad as last year. So we do have more bushels that we're dealing with. So it will take a little bit longer to be able to chew through that pipeline, but I think longer term it's going to happen.
All right. Yeah, I think I agree with you on that. The wheat has had such a struggle with any type of demand this year that is going to be something that's going to hold us back. But hopefully we can get some sort of a basis improvement. And if we get some news about a country having supply issue, we should have an opportunity to go ahead and make sales in wheat. I'm looking to sell the carry in the Minneapolis wheat. We're about 60% sold, and so we're carrying over in storage about 40% of the crop, and looking at a sharp rally to go ahead and liquidate and make some sales of the Minneapolis wheat. There's a 22-cent carry compared to December. And once sold, there's no downside price risk. I think I failed to mention in the soybeans that there's over a 50-cent carry from November to July, and that's just unprecedented. Normal carry is about 30 cents for corn and soybeans into the summer months, and so that's just unprecedented that there's that much carry. You want to take advantage of that, and with this strategy in Minneapolis, if you do want to retain ownership, again, look at some call options, 2 to 3 cents per month. That gives you some upside potential with really no downside risk once that crop has been sold and marketed. So I like these strategies. Jody, you've given us some good things to think about, ways to generate cash flow. I know everybody's in need of cash flow this time of year with the impending harvest and a lot of expenses coming due. So great way to talk about generating cash flow. Limit your risk this year, make some sales, use the storage to your advantage, use the carry in the market. And I think we can come out with some decent prices for at least 2018 before we start looking at 2019.
Yeah, I think so. I think if we just make some smart moves here, we'll be able to come out of 2018 with very few scars and move forward to the optimism of 2019.
Very good. Thanks, Jody. I appreciate you being on. Once again, why don't you give us your phone number at your office there and your website?
Oh, Northern Ag can be reached at 218-681-1431. That's our office in Thief River Falls, Minnesota, or you can go on our website at www.northernaginc.com.
Very good. Thanks, everybody, for joining us. This has been Brian Hoops with Jody Miller from our Thief River Falls, Minnesota office. Have a great day, and thanks for tuning in.